I'm Beaulieu, ITR Economics. Today is September 8th, and thank you for joining us for this edition of FedWatch. Fairly straightforward discussion here today. One, apparently I haven't been clear enough in the past, or so my team tells me anyways. It is not probable that the Federal Reserve is going to get us back into a normal yield curve situation by the end of 2023. I mean, anything's possible, it's just not probable. And the failure to do that by the end of 2023, or the failure to see that normalized yield curve really as late as the end of the 1Q 2024, puts the timing of the onset of recovery in jeopardy. And because it's not probable that we're going to get that normalization, that part of the forecast is under watch. In fact, when I updated the leading indicators yesterday, the furthest out looking leading indicators, and there are 3 or 4 of them that I rely on, are now saying not fourth quarter 2024 for the low, but 1Q 2025. But they are telling 1Q 2025. So while the timing may slip from December 2024 for the US industrial production 12/12 low, it doesn't look like it needs to slip beyond March based on these other indicators. And these are financial based indicators that I'm talking about. Well, one of them is actually the savings rate of people here in the United States adjusted for inflation, but that's financially related. The bond market is another one, and existing home sales is another one of those 3 indicators that are telling us about then is when we're going to see the onset of the recovery. What happens if the Fed does not lower interest rates after 1Q 2024? But we'll have to cross that bridge, obviously, when we come to it. You just have to wait and see. And the reason I'm pausing on that is because I was reading this great article in the Wall Street Journal. The numbers are telling that the bank exposure to the commercial real estate market totals about $3.6 trillion. It's about equal to 20% of all deposits in the bank. So it is a big, hairy number. About 2/3 of that $3.6 trillion is held by regional and small banks. That's defined as banks that have less than $250 billion in assets. So they're highly exposed. And right now, if a bank isn't performing, it has to be recognized and written down, or the bank has to end up owning the property at a greatly reduced market price. The price deflation in office space and in apartments has really exposed the banks to a degree that they never anticipated. And that's likely to have a trickle-on effect to other loans from these banks, because if they're upside down on some of these other mortgages and they have to watch their other ratios, and they just may be more reluctant to make some loans. You could argue that they'd want to make some of those other loans just to help balance their ratios, but they don't always think that way. So we're concerned that the credit tightening is going to continue through the end of this year, and it may endure through 2024, certainly at least through the first half of 2024. That would be normal. Wouldn't be surprised to see it go longer. Cash remains king. The availability of cash remains absolute supreme. And all these numbers don't even take into consideration the indirect lending that banks and others have been making into the real estate environment. They do this through the non-bank commercial securities, mortgages, in other words, bonds. They do it by lending money to REITs. They do it by going to landlords and lending them money, or somehow it's tangentially related to the real estate market. So that 3.6 trillion cited by the Wall Street Journal is really, it's the biggest chunk, but it's not total pie that we need to worry about. And we've mentioned before, this ties into the mountain of debt that needs to be refinanced in 2024, 25, and 26. And in 24, we're not getting enough interest rate relief to see this mountain of debt do anything but be crushed and not at all helpful for the economy. And every time I hear somebody say, it looks like we're going to have a soft landing, don't worry about it, everything's fine, the consumer's fine, I think about this $3.6 trillion and the fact that corporate profitability is heading downward. It's in phase D of the cycle, and I'll be writing about that, by the way, in this month's executive summary of the trends report. All these factors on the business side of the street can't be ignored just because retail sales in July were reasonable. This doesn't have to be Armageddon. It doesn't have to preclude 2025 being a recovery year either. There's two things really that the Fed could do. They could lower interest rates more aggressively in 2024 than they have heretofore indicated they may consider. That would be amazing for the economy, getting it back going again. And the other thing they can do is, and this has been done before, I believe it was done in 08 or it could have been 09, they can give the banks a wink and a nod and say, you don't have to mark your mortgage loans, those mortgage-backed loans, to market value. Just keep them at prior valuations so that you don't ruin your ratios, you don't hurt your capitalization, and we'll address the problem down the road. And that's just kicking the can down the road, but it is something that they did before and it worked in the Great Recession. So they have those two levers that they can pull. We'll have to see which way they are going to go about it. So in summary, we don't expect a normalization of the yield curve until at the earliest, probably I think 2Q 2024. It may extend beyond that, which puts the timing of the recovery into, right now it looks like 1Q 2025. We'll be running those numbers some more. We've got some good leading indicators that are telling us about that point in time. But the strength of that recovery, I think, is going to be partly a function of how bad the commercial real estate market takes down these regional and smaller banks. Good news in all of that is that the large banks are not in play or in danger in this realm. And they indeed, as the Fed has been saying, look to be solvent and able to weather this storm. It's the smaller banks you need to worry about. This is Brian Beaulieu for all of us at ITR Economics. Thank you for joining me for this edition of FedWatch.